NVIDIA just delivered another blockbuster earnings report. Revenue beat, EPS beat, margins incredible. So why did the stock drop sharply? Today, we decode what this really means.
If your portfolio is heavy in growth stocks, especially AI leaders, this price reaction is a warning sign. Not panic, but real risk.
When a company crushes earnings and the stock still falls, history tells us the market cycle may be shifting beneath the surface.
We saw this exact pattern before with NVIDIA, phenomenal results, muted price response.
It's like scoring straight A's and your parents still look disappointed. The problem isn't performance, it's expectations.
Let's address the big question: if fundamentals are strong, why sell?
2 macro reasons. First, late cycle bubble behavior. Second, policy uncertainty. A new Federal Reserve chair means markets must reprice liquidity assumptions.
When liquidity expectations become unclear, high-multiple stocks feel it first. Even small changes in discount rates hit future cash flows hard.
In simple terms, when the tide stops rising, the tallest boats feel the wobble first.
But let's be clear, this is not a collapse signal, not yet.
Structurally, this looks more like March 2000 than October 2000.
Meaning we are likely in a late-stage expansion phase, not in full narrative breakdown.
You still have time to exit smartly. This isn't jumping off a cliff, it's planning your landing.
Let's look at the actual numbers. Revenue grew 75% year over year. EPS came in at $1.62 versus expectations of $1.53.
Adjusted gross margins held at 2%. Data center revenue remained dominant. Every major metric beat consensus estimates.
So why did the stock fall? First reason, expectation trap. The market expected not just growth, but acceleration on top of acceleration.
Second, guidance, strong, yes, but not dramatically higher than the whisper numbers institutions were modeling.
Third, valuation. The market already priced in roughly 2 to 3 years of future growth.
Fourth, capital rotation. This wasn't retail panic selling. Institutions were quietly rebalancing.
And fifth, this resembles the classic Cisco moment from the 2000 bubble.
Every bubble transitions through 3 late stages.
Stage 1, expectation exhaustion. Earnings beat, stock barely reacts. That's where we are now.
Stage 2, multiple compression. Earnings still grow, but valuation shrinks.
Stage 3, narrative breakdown. Suddenly people say, maybe this isn't as revolutionary as we thought.
We are transitioning from stage 1 toward stage 2. That's a structural shift.
In March 2000, Cisco systems traded at nearly 100 times earnings. Revenue was growing above 50%.
It became the most valuable company in the world. Sound familiar?
From March to December 2000, the stock fell about 40%, even though earnings remained strong for months.
By October 2000, the trend had clearly broken. Lower highs, weaker rebounds, that was phase 3.
Today, NVIDIA still shows strong earnings momentum. The trend isn't broken. That's why this feels like March, not October. Let's get practical. 3 things not to do.
First, don't short NVIDIA outright. Momentum and institutional ownership make that dangerous.
Second, don't rotate into a smaller AI stock thinking it's cheaper. Beta risk increases.
Third, don't double down hoping for the next earnings squeeze.
What should you do?
Hedge with index exposure. Add dividend payers, increase cash flow stability.
Consider volatility strategies instead of pure directional bets.
Shift your portfolio from narrative-driven growth toward cash flow-driven resilience.
So what's next?
AI adoption downstream is real. Productivity gains are measurable. This technology is not fake.
But markets overshot between 2023 and 2025. FOMO pushed valuations beyond sustainable ranges.
Great companies can be overpriced. That's not an insult, that's math.
NVIDIA is a great company. AI will reshape industries.
The new Federal Reserve leadership may prevent extreme bubbles or crashes. Policy will matter.
This isn't about predicting collapse. It's about recognizing phase transitions.
You don't need to panic, you need to adapt.
Bubbles don't end when earnings weaken. They end when expectations exhaust, and that process has begun.
Thanks for watching. Please subscribe our channel. See you next time.